So we are doing IFRS 9. Okay, in that always this is what is happening. We are not getting continuous class. So every time I have to give a brief out and go ahead with. So financial instruments we are doing. And we did few problems in last class. I told you it will be similar to lease calculation where we'll be computing a percentage of interest and then amount will be paid. That is, it is not a prepayment method of lease. It is post pay. That is not post payment, later payment. Okay, end of the year if you are doing any payment, that type will be covered here. And you'll be having two interest factors given in the question whenever you're computing the amount paid and balance carried forward. One is market interest rate and another one is how much you are paying. Okay, based on the market interest rate only, we'll be computing the present value factor here. So these are the information which I want to give. So let me go again. A glance of the PPT we'll see once. Coming to financial instruments, financial assets, financial liabilities are there separately, and you have a compound instruments like convertible, any convertible kind of instruments are there, means we'll call it as compound instruments, where a portion will carry a equity quotient and another portion will be having a debt quotient. So debt quotient, normally redeemable preference shares, we'll call it as debt quotient here. Okay. And then what else? This particular IFRS 9 means actually this is a financial instrument only. We are learning only IFRS 9, which is measurement of your financial instruments. But you have IAS 32 and IFRS 7. IAS 32 will speak about classification of financial instruments and their presentation, whereas IAS 7 speaks about what and all you are expected to disclose regarding financial instrument in your financial statement. So we are going to cover, emphasize is more on IFRS 9. Then coming to 46, we saw what is a financial asset, and we got to know it's trade receivable, options, investments in equity shares and all. We'll call it as financial asset. You can immediately correlate with your cash flow statement, financing activity, what and all you'll take there, that and all with your financial asset and liability. Okay. Then coming to financial liability, but trade receivables and trade payables normally will not take in financial asset in cash flow statement. That will be taking in debtors and creditors. But that one part you have to include here. Other than that, everything what and all is coming in your financial activity will be taken here under financial asset and financial liability. Then considering the measurement, financial liability, initially we will we'll record it as fair value, that is net proceeds of cash received less any cost of issuing the liability. Okay, initial recognition of financial liability will be fair value method, and later on subsequent measurement will be amortized cost. These are the points which you have to remember. Okay, that is initial recognition will be fair value, subsequent measurement will be amortized cost. What is amortized cost? Initial value plus effective interest minus interest rate. Effective interest is market interest rate. See here the problem which we did. See here. Okay, market rate is 10%. That is the effective rate, and the coupon rate which is mentioned in your loan or how much you are paying every year will be the amount paid. So this is what is mentioned here. Initial value, that is balance brought forward, plus effective interest rate, that is your fixed finance cost at 10% the market value, minus interest paid or amount paid. So this is the amount what we are paying. That will be your closing balance, that is amortized cost. Fine. So I'm just giving a going through the slides because chances are there you would have forgot. So now next one is preference shares. So preference shares, irredeemable preference shares, redeemable preference shares we have. When we consider irredeemable preference shares, it is classified as equity, whereas redeemable preference shares, it is classified as financial liability. When it is classified under equity, if it is having no obligation, irredeemable preference shares, when we will redeem it only at the time of liquidation. Your company is winding up, that time only they'll be paid. So they are called as irredeemable. So they carry the characteristics of equity shares. So we classify as equity. Whereas redeemable preference shares, maybe after 10 years or after 5 years, you have to redeem it. So it is carrying a obligation in it. So we classify it as financial liability. Since we are classifying it as financial liability, we'll be valuing under amortized cost. Then coming to interest and dividend, equity dividend is reported in the equity, and any dividends on instruments are classified as liability. That is, if you're paying any preference dividend for redeemable preference shares or any interest you're paying to any convertible loans, that and all will be considered as a finance cost in SOPL. Then we'll take into consideration compound instruments. Under compound instrument means same instrument possessing the characteristics of equity and liability. Okay, we call it as a compound instrument. Okay, so it is repayable at lenders of this part and all we covered in the last class. Okay, this you can go through that. Then coming to convertible instruments, that is, I said about financial liabilities, initially fair value and then later on amortized cost. Coming to convertible instruments, initial recognition will be, as I said already, we have liability and just a minute. Okay, so under convertible instruments, you'll be having a portion as equity and you have another portion as liability, right? The equity liability part, how will you value? Same, fair value, initial recognition, right? Initial recognition will be like this, fair value, and equity will be equity element. How will we find out how much is the liability from the entire loan or entire instrument minus the liability? You will be having your equity. Okay, I can tell loan value or any, yeah, loan notes. I'll write it. That will be a very good example. Loan notes minus liability, if you put, that is equal to equity. That is your initial value. And later on, subsequent measurement, okay, if you see liability, as I said, it will be considered as amortized. No, so amortized value will do. And whereas equity, we will not revalue it again, remains same. Okay, so based on this illustration 3 and exam kit 94, I should have done. I'll just check whether I've done that or not. Illustration 3 is over. Exam kit 94 is not done, so we'll do that. Oh, that is also done. So we'll do exam kit problem number 94 so that we'll get a brush up now. Okay, so problem number 94 on 1st October 2003, B issued a 10 million convertible loan notes which carry a coupon rate of 5% per annum. The loan notes are redeemable on 30th September 2006 at par for cash or can be exchanged for equity shares. A similar loan note without conversion option would have required B to pay an interest rate of 8%. Okay, that is, they are having a coupon rate of 5%. They are going to pay only 5%. Why they are paying only 5% and the person who issued loan note is also happy? What is the reason? This we discussed in the last class. Can anyone tell me? You are paying less than the market rate, then two people are happily going for convertible loans. What's the reason? Will you accept the less than the market rate if someone is paying you any interest or any income? Will you accept it?
Yes, ma'am.
You will accept. Yeah. Yeah, tell me why you will accept.
Ma'am, less no.
Will you accept? That is, for example, you are giving a loan note. In the market, you will get 8% interest, but you're giving to a company on the basis later on you'll be converted to equity. You're giving 5%. What is the reason? You're losing your current profit, no? Of 3% extra. Why are you giving them? You cannot hear. Who's that? No, there is a very bad problem in your mic,
Saurav,
I
ma'am.
guess. Saurav, okay. No, Saurav, your mic is not working. Okay, fine. No, it's not working. Something is wrong in the mic. Let me tell you, see, you are the only reason is after some years you'll be getting converted to equity, and if you see the proportion for every $100 denomination, you'll be getting 20 shares, 30 shares, like that enormous number of shares you'll be getting in the form of. Okay, so I think someone messaged me here. Okay, there is a message in the group. Roll number 72. Okay. Then the person gets to be a part of decision making process. Yeah. Some may have power crunch. That's the reason they may go there. But a logical reason could be later, after some years, I can get it converted to equity and I can sell it at the market price if the equity is going at a higher rate, which I'll get double and triple my profit. So in a foreseeing capital appreciation notion, they are accepting this lower interest rate. Okay, that is the intention in general. But of course, they are taking a risk. If the market price is falling down, that's your fate, can't help, right? The assumption is the market price will go up and they can sell it at a higher price, all these shares, what they are acquiring, and get a huge profit and settle. That is the intention for going with this. Okay, we leave that, and also 8% is the market rate and 5% is what you're paying. The question here is how much would be recorded in equity in relation to loan notes. So they speak about only the issuing time, right? The loan notes are redeemed on 30th September 2006. So initial recognition, okay, how we'll be doing? We'll first find out how much is my debt, and then from the total amount, if I subtract my debt, I'll be getting my equity. So I have to find how much is equity. So let me go one after the other. So the first one, this is the end of the year, right? End of year 1, 2, 3 and all, because if you see here, it is 2003, it is issued and redeemed at 2006. So let me put the columns, it will be easy. So years, then cash flow, what cash flow? 10 million convertible loans which carry a coupon rate of 5% interest. Okay. 5% interest, cash outflow or else amount paid, whatever. Right, cash flow from the company point of view also it will be easy. Cash flow at 5%. Then we'll be having discount factor. Discount factors are given. So which you will take? 5% or 8%?
8%.
8%. So 8% is a discount factor. Then I'll be having present value. Okay, let me see year 1. You can write the year also. So how much is the cash flow? If you see it is 10 million, right? 10 million at 5% you're paying. Right. Year 1, instead of year 1, you can write end of year 1 also. End of year 1 is what? Which year?
2004.
2004. Then it will be 2005, 2006. Done. So cash flow will be how much? I'll just write the amount here. It will be easy. It is 10 million, right? 10 million is the amount. So for that, I'm going to find 5% is equal to this into 5%. Okay. It's equal to this into 5%. But last year, what's happening on 30th September? I have to redeem it. So how much I have to pay now?
Plus principal amount.
What? Yeah, interest plus principal amount. This amount plus this into 5%. So $10,500,000 I'll be paying. Right. So This is the amount which I'm expected to pay at the end of the year of redemption. Now coming to the discounting factor at 8%, I'll be taking 0.9. They've given, no need to, you need not go and compute it. They've given means just take it as such and do it. 0.79. So present value is what? How will you compute? Is equal to?
Cash flow 5% into discount factor at 88%.
Yes, is equal to, sorry. Into this. So if I sum it up, this is my value, which this is my debt value. And how much I borrowed actually? This is a cash receipt.
10 million.
10 million. Done. So what is the equity here?
10 million minus the present value.
Exactly. Is equal to 10 million minus sum of the present value. So $810,000 is my equity. I borrowed some money, but I'm not going to repay now. Slowly I'm repaying. So what I have to do, I have to find out, since I'm not repaying immediately, end of the year only I have to repay. So I'll be computing the present value computation. Okay, I'll keep on computing, and at the end of 3 year, I'll be getting $9,190,000. I'll be paying this much only, but I've received a 10,000. So 810,000 worth of equity I have to issue. It has a component of 810,000 of equity. Dollars of equity. Okay, this is the initial recognition. So here, 3 zeros you have to remove. Be careful whenever such type of question is given. So you have to write 810. Can you understand?
Yes, ma'am.
Okay. So this is what is asked and its answer. Okay, let us go to the PPT once again. Financial asset, how will you recognize? So financial liabilities, illustration 3 and exam kit we did. The subsequent measurement, whenever the problem is coming, we'll go ahead. So liability, how will we measure? It is given very clearly here. Liability is measured at its fair value. Fair value means what? Present value of future cash flows. Okay, that is discounted at market rate of interest. This is my liability value. And what is the equity element? Loan proceeds. I borrowed 10 million. In that, the fair value computation, if I subtract, I'll be getting my equity element. As per the theory only I went. Now let us go to financial asset. This theory I explained in the last class. That's why I didn't explain once again this fair value. So coming to this financial asset, initial recognition will be at fair value. Purchase consideration, most likely the purchase consideration, fair value. Okay. Then transaction costs are included unless the asset is FVPL. So when it is financial assets, so we have two types of measures. We have three types actually. One is fair value through, we'll see one after the other, fair value through profit or loss. Another one is FVOCI. Okay, so yeah, two methods are there. So whichever method you're going, in this fair default, by default, nothing, the problem is completely silent, means you are going to measure the equity under FVPL, fair value through profit or loss. What is this FVPL, FVOCI? Very simple. How you're going to present it matters here. Okay, so here transaction costs are included unless the asset is FVPL. When this transaction cost will be included? When it is FVPL or FVOCI? Unless the asset is FVPL means, because that English is also different here. It's a book one. I didn't write on my own. The transactions are included only if the asset is FVPL. Clear? That will be clear, I guess. Only if the assets are valued at FVPL, that is fair value through profit or loss. Okay. So equity instruments are measured in two ways. One is FVPL or FVOCI, that is other comprehensive income. Why other comprehensive income and all are coming here? Because we have to revalue, and any profit or loss we have to take, no? That's the reason. So under fair value method, how will we go? This is the default category of any equity investment. That is, when you're investing in another company in the form of equity, the default category is FVPL. Okay, keep this in mind. This is the default category. If the problem is silent, you have to measure in FVPL only. Any transaction cost on purchase will be taken to SOPL. That's why fair value through profit or loss. And at the end of the year, revalue at fair value. You have to revalue the asset. And if there is any gain or loss, that also will be taken to SOPL. Though you are not selling the asset, you have to take it to SOPL only, like investment property. In investment property, what we'll do, we'll revalue the asset, and the revaluation gain we'll take it to SOPL, not to OCI. Same here. FVPL means you have to take the revaluation gain to SOPL only. Okay, what is the second method? The second method is fair value through other comprehensive income. The entity can classify equity investment to FVOCI only on acquisition if it is intended as a long-term investment. See, they can classify, they can take it to FVOCI, but this can happen only at the time of acquisition, only at the time of investment, beginning itself. And once if you go to FVOCI, later on, you cannot change it to FVPL. That is, once you classify as FVOCI, you cannot change it to FVPL calculation. It remains the same. So two conditions are here. This can be classified only at the time of acquisition if you're going to hold it for a long time, because all the shares, what and all you're investing is not a long-term asset. Sometimes you may be a speculator also. That is, you just keep on buying and selling, and the difference of profit you gain. You run your, what to say, that is a source of income for you. That type of category we are not considering. If you are investing for a long term, and at the time of acquisition, you can value it as FVOCI. And later you cannot be changed to FVPL. You cannot change it. Keep it in mind. Then FVOCI transaction costs are capitalized. So in the previous method, transaction cost, we'll take it to SOPL. But here what's happening? These are capitalized. It is be added to the asset value, that is added to the shares value. So these are capitalized, and investments revalued to fair value at the end of each year. And gain or loss is taken to OCI, that is other comprehensive income. And later on, this OCI will be in your SOPL, right? And this investment reserve and equity will be in your SOFP, because adjustments will appear twice. So any asset, any investment related to equity is revalued under FVOCI, means the gain or loss should be taken to OCI, that is in SOPL, other comprehensive income, as well as an investment reserve in equity, similar to revaluation of PPE. But this reserve can also have a negative value as well. Okay, so here it is taken to investment reserve. It can be positive as well as negative. Then on sale of FVOCI investment, the investment reserve can be transferred to retained earnings or remain in equity. Same like PPE. In PPE, what we'll do, we will revalue an asset, and if you are getting any gain, you will take it to OCI, and then you will take it to revaluation gain. And if the asset is sold, means that any balance remaining in revaluation gain will be again transferred to retained earnings. Same here. If you are selling an FVOCI investment, the investment reserve can be transferred to retained earnings or remain in the equity. You have both the options, but in general, it will be transferred to retained earnings. Could you understand the theory concept? Without theory, you cannot do practical. Could you understand this? Two methods are there. Can you understand?
Somewhat, ma'am.
Somehow. Okay, fine. Okay, so let's go with the exam kit 90, problem number 90. Okay. What is the default classification for an equity investment? This was asked in one of the year exam, one of the question also. What is the default classification of equity investment? Just now I was
Fair value to profit or loss.
fair value through profit or loss. Okay, this is the default category. Then now you answer me my question. Fair value through OCI. When, what are the conditions? Yes, fair value through OCI. Default is FVPL means
Default
when can I go? Yeah,
Sorry, ma'am.
yeah, give a try.
Only on acquisition,
Only on acquisition, and what type of investment it should be?
long term,
Long-term investment. Can you go back to FVPL?
no.
No, once classified as FVOCI, you cannot go through FVPL. Okay, fine. So that's it. Little bit of theory and one question to answer. Let's go to the debt instrument. Okay. Debt instruments, that is investment in bond and redeemable preference shares. Okay. So here default category is FVPL. Okay. FVPL, default category is FVPL and can be carried at amortized cost. So FVPL is the default category for shares if you invest. If you invest in debt, see both are investment, keep that in mind. We are not speaking about liability, we are speaking about investment, asset side. So if you have invested in some of the companies, bond or a government, not government bond, any company's bond or redeemable preference shares or any debentures you've invested in any other company, then that time also it will be by default valued at FVPL. And it can be carried at amortized cost, but this time you will receive interest. Keep that in mind. When you can carry at amortized cost, if the following two tests are passed, this is also a question paper question. So what are the two tests any instrument have to pass it? The first one is business model test. What is a business model test? Entity must intend to hold the investment to maturity, long time. Okay, till the time of maturity, you should have an investment to hold the, you should have an intention to hold the investment. Then we'll call it as the particular asset passed through a business model test. Okay. Number two is contractual cash flow characteristic test. That is, the contractual terms of the financial asset must give rise to cash flow that are solely of principal and interest. There should be some increase, okay, increase in the cash flows. Okay, that is principal plus interest should be there, flow should be there. If two tests should be passed, then only you can carry at amortized cost. Otherwise, you have to go with FVPL only. Okay, so under this contractual cash flow, how we'll calculate interest income calculated is using effective interest market rate will be taken to SOPL as interest income. And year-end asset value will be calculated like this. See here, we just now saw like initial amount, add amortize something we calculated, no, initial amount plus effective interest minus interest paid. We'll be getting amortized cost. Yes or no? We did a calculation, no, just now.
Yes, ma'am.
Yes, here see initial value plus market rate of interest minus interest paid. This is in case of when you are paying interest, if it's your liability. In this case, what is it? It is the initial amount. Okay, this balance brought forward is your initial amount. And plus any interest income. Okay. Interest on that investment. Then if you received interest received, you have to subtract. And then you'll be having the remaining closing balance. This is how we'll be computing year-end asset value. This is your year-end asset value. How will you compute initial amount plus interest on investment minus interest received, the remaining balance, year-end asset value. This is how we compute it under amortized cost. Not amortized cost. In general, year-end asset will be computed like that. But to classify a particular asset into amortized cost, it has to pass two tests. One is business model test, which you are going to hold an asset for till the time of maturity. And one more is contractual cash flow characteristic test, which means that it will keep on, there will be a cash flow throughout the time you're holding the asset. There will be some cash inflow, which includes principal plus a quotient of interest. And interest income, this interest income, right? We calculated interest there also at market price. So this is also at market rate. Okay, it will be computed at market rate. So then it can be carried at FVOCI. So default category is FVPL. Can be carried at amortized cost also if we pass this two tests. What is the third category? It can be carried at FVOCI if the following two tests are passed. Again, the two tests only, but see here, business model test, the entity must intend to hold the investment to maturity, but may sell the asset if the possibility of buying another asset with a higher returns arises. So here also you should have, okay, under FVOCI, if you want to value a particular debt instrument, if you have invested in a debt instrument, you can value an FVOCI. It has to pass through two tests if you want to value an FVOCI. First test is business model test, which means that the entity must hold the investment till maturity, but they can sell it also if in case they can get higher return in selling and buying another asset. If they're going to get a higher return in this process, then they can sell it. So this is business model test. And then contractual cash flow characteristic test is the contractual terms of financial asset must give rise to cash flow that are solely principal and interest, same like the previous one. And initial recognition will be recognized as fair value plus transaction cost, because just now we saw in FVOCI, in FVOCI, transaction cost will be capitalized, right? So same here. Fair value plus transaction cost is your initial recognition. And any interest income is coming means we can show it in SOPL, and the assets will be revalued to fair value at the reporting date. And if there is any gain or loss, you can show it in OCI, and you can reclassify to profit or loss if you are selling the asset, same like the equity investment. Okay, fine. So you will understand at least a 20%, I guess, not more than that. Okay, you can get 20% like that. Only while doing the problem, you'll understand a little bit. Okay, this derecognition will come back later. So we'll go to the problems now, one after the other we'll solve, you'll get an understanding. So we'll take this for a debt investment that is just now we discussed. To be held under amortized cost, it must pass two tests. One of these is the contractual cash flow characteristic test. What is the other test?
A.
Business model test. What is business model test?
Intention to hold it
Hold
till
the
maturity.
Intention to hold the asset for till the maturity time. It is same, no? In equity also we study the same. In debt, in both are investment. Equity investment also same we study. Debt investment also same we study. What is the difference add on in debt investment? You should only hold or anything else is there? In debt investment.
Buy another asset with higher returns. If there are
Exactly,
higher
you can
returns.
sell and buy another asset if you can, if will provide higher rate of returns than the previous one. That also is the business model test. Okay, fine, very good. So let us go to the next one, 91. See, everywhere is solved and here. You will know, right? I'll be maintaining a notebook. For that, I solved and kept. That's the reason. So just we'll see. 91. ABC purchased 10,000 shares on 1st September 2004, making the election to use the alternative treatment under IFRS 9 financial statement instrument. The shares cost 3.50 each. Transaction costs associated with the purchase were $500. At 31st March, December 2004, the shares are trading at 4.50. What is the gain to be recognized on these shares for the year ended 31st December 2004? How many of you can understand this problem? So under which method they are purchasing 10,000 shares? ABC purchasing. First tell me whether it is an investment or a financial liability.
Investment.
It is an investment. First question you answered very good. Pat on your shoulder. Now second one, they are making the election to use, they are electing to use alternative treatment. Which is that alternative treatment and which is the default treatment?
Okay. If we OCI fair value through other comprehensive income.
That is default or alternative?
Alternative.
Alternative. Yeah, alternative they are going. Alternative you can go use amortized cost also, as well as, because no, amortized cost you cannot know. It is a equity instrument. Equity instrument only two option, either FVPL or FVOCI. So in AB, this alternative is FVOCI. So you know we are purchasing, so we are investing, and we are going to use FVOCI. That these two classifications you have done now. Now, what is asked? What is the gain to be recognized on these assets on 31st December 2004? When are you purchasing this asset?
1st September.
Okay. Now, let me go to the theory part here. One problem we do also perfectly we should do. This is a financial instrument, right? And I'm going to use this method, FVOCI. Transaction costs are capitalized. What do you mean by that?
Included.
In what? You're correct. Included in what?
Investment, ma'am, in this only.
In that 10,000 shares when you're buying, no, how much you're paying and buying?
3.50.
Exactly. So 10,000 into 3.50 plus 500 is your cost of the asset, right? Cost of 10,000 share is that only, because you're capitalizing. Capitalizing means add with the asset. Very simple. So now I'm going to value this and start from here. I think this will be fine. And right here, my handwriting is a little bit big. That's the problem. So it is equity under, I'm going to value equity investment again, right? Very clearly, equity investment under FVOCI. So as per that, my transaction cost will be capitalized. Keep that. Understand theory is not strong means you cannot do the practical. Keep that in mind. So first I have to do initial recognition. How will I recognize? Initial recognition. So first I'll be taking cost of 10,000 shares. Oh, sorry. At $3.50 each.
$35,000.
Okay. 35,000. Okay. Plus transaction cost. Transaction cost, it's given here $500. So this is 35,500. Okay. I'm valuing under FVOCI. Okay. So now tell me, what is the present value of the shares on 31st December 2014, 2004?
4.50.
Huh? I didn't get you.
Fair value, ma'am.
Yeah, what is the fair value of the shares? Is it given anywhere? What happened, class? You didn't understand?
Is it 4.50, ma'am?
Yes, 4.50. That's what it's mentioned. No, shares are trading at 4.50 each. That is your fair value. It's trading price. I discussed yesterday only the fair last class only fair value computation. Shares trading price we will take, yes or no? Trading price is 4.50. It is on 31st December 2004. So I'll just leave one line here and I'll be computing revaluation.
Ma'am,
Hmm.
then the cost on 1st September, it's the cost on 1st Jan is 35,500, na, ma'am?
Yes, correct. So if you want to write the date, okay, fine, I'll write the date. It's not required, but still I'll write it here. This is on first. Oh, they are purchasing on 1st September. Better not to write the date, not required at all here.
Okay.
Okay. So we don't do use depreciation and all for shares, so no point in writing the date here. So year end, what's happening? The same share that is on 31st December, the revalued amount or revalued to fair value. That is what we have to do. No, go to the theory again. Theory, if you see, investments are revalued at the end of the year, and gain or loss is transferred to OCI and then to investment reserve and equity. Correct. So revalued to fair value. What is the fair value? At
4.5.
yes, 4.50 each. So now it is 10,000 into 4.50, right? So 10,000 into $4.50. So it is 45,000. So what is the diff? What is it called as? 9,500 is called as what?
Gain.
Gain. Where it will be taken?
OCI.
OCI. Fine. So let us see what is asked here. They are just asking what is the gain to be recognized. It is $9,500. Could you understand?
Yes, ma'am.
Let us go to this problem number 92. DEF purchased 15,000 shares in KMH company on 1st August 2006 at a cost of 6.50 each. Transaction cost on the purchase amount is 1,500. At the year end, these shares are now worth 7.75. Did they mention which method they are following? This,
No, ma'am.
so
No,
which
ma'am.
method we have to do?
Default.
What is the default method?
FVPL.
F FVPL.
Yes. So equity, just a minute, 1 minute. Hello.
Yes, ma'am.
Yeah. So 1 minute. So equity under FVPL, right? This is the default. So I'll just write it as default so that you can understand. I'll be considering only this method now, default. Okay. So under this, let me go to the theory again. Going very slowly. There is any confusion, you can ask me. What is the default category? Equity. This is the default category of equity investment. Any transaction cost, what we should do?
SOPL.
Yes. We'll take it to SOPL. And at the year end, the assets will be revalued. And where we'll be taking the revalued gain or loss?
SOPL.
That is also SOPL. So when we are valuing in FVPL, there is no point of confusing with OCI. Okay. So let us see now. So in this problem, again, initial recognition because I'm purchasing. DEF purchased 15,000 shares in KMH on 1st August 2006 at a cost of 6.50. So let me take that. So cost of, I'll write initial, for your understanding, this initial recognition, I don't need not write it for your understanding. Coming to the initial recognition, what I'll do, cost of 15,000 shares at how much is the cost? It is mentioned as 6.50 each. Okay.
$97,500.
So 97,500. This is my value here. And then will I add the transaction cost? 1,500 here?
No, ma'am.
No, ma'am.
No, I will not add. Okay. Here also revaluation is happening, right? So what is the revalued amount now? Year end. Revalue to fair value. How much it is?
7.75 into 15,000.
Very good. Revalue to fair value at 7.75 each. So it is again 15,000 into $7.75. So how much you're getting?
1,16,250.
1,16,250. So if you balance it,
18,700.
18,750. This is what? This is your revaluation gain, right? This gain, where you'll take it?
SOPL.
So select the correct gain and the place it will be recorded. Right? So which is the correct gain in it?
18,750.
And where it will be recorded?
SOPL.
Done. Correct. If you have taken that 1,500 here, it will come to 99,000. So you will be having the next answer. This answer will be there, I guess. No, right? No, yeah, it'll be having 17,250 as the answer. That's why they'll give you some confusing answers here. Okay, so one more answer. Can you answer 93, question number 93? For which category of financial instruments are transaction cost excluded from the initial value and instead expensed to profit or loss?
B.
Let us check from one. Financial liabilities at amortized cost. Financial assets at fair value through profit or loss. Only in this we are considering transaction cost first of all, right? So OCI and all, no, we'll add it. Amortized costs also leave it. So only B is the correct answer. Okay. So what are the problems left out? 95, 96 and constructive based. That's it. Okay, fine. So next class, I'll be finishing this chapter.